By that time, I think they will have been deleveraged and will be past the maximum pressure associated with this guilt trip. We're seeing other changes. We've seen China intervene to limit the weakening of the yuan. We've seen Japan doing the same. Now, what is that? What are they doing when they do that? Well, when Japan is trying to support its currency at 145 yen to the dollar, what it does is it sells dollars and buys back yen. Now, that's good in a way. It's doing some of what the Fed should be doing here, actually. It's providing dollar liquidity to the rest of the world. China is doing the same thing. And so we'll see what happens from here. I think this is getting to be so serious that we are reaching a cathartic moment. And I do think it started with the guilt trip. And the Fed has acknowledged that there are international ramifications to what it is doing, but it is thinking first and foremost about the U.S. This reminds me a lot of the early 80s and what happened in the early 80s. There were two accords, the Louvre Accord and the Plaza Accord, where the treasury ministers around the world all agreed to sell dollars to limit the deflationary impact on the rest of the world. And when I say deflationary impact, there are countries, sure, their currencies are falling apart, so their inflation rate they look like they're in hyperinflation or heading in that direction. But they are being strangled by dollar-denominated debt that they cannot service. So this ends up being quite a deflationary situation longer term. We're wondering what in the U.S. is the weak link. Is it our pensions? We don't know. We know there are LDI strategies in the United States. They're not as leveraged as we understand, but one never knows. If not that, what are some of the weak links that we're seeing? We've been worrying about auto credit for a while now, and now we have more reason to. Yesterday, we got the Mannheim used car index. It's a value index, pricing effectively, and it dropped another 3% plus. It was 4% plus decline last month. And so what we have now is the year-over-year increase has gone from 54% in April of 21 to minus 0.1. So there you go, Fed. There's another indication that deflation is in the system. That index peaked in January and is now down 14% just since January. It's declining at more than a 20% rate. Now, why is this important? Well, a lot of auto paper out there makes assumptions, or the investors make assumptions about the residual values of cars. And those residual values have been going up, maybe not as much as the used car index, but they have been firm. If we're right, the used car price index is going to collapse here. Why? Well, many people bought cars during COVID because they wanted to avoid mass transit. Under normal conditions, they didn't need that car. Nonetheless, they were quite happy to see used car prices going up with the thought that when the coast is clear, they would sell back into the market, into the used car market. And as I mentioned, used car prices were up 54% on a year-over-year basis at one point. Now they're flat to down. And now dealers who were paying too much for used cars are sitting on losses, and they are going to have to disgorge those inventories because inventories cost money to carry, especially as interest rates are going up. So they're going to be forced to sell. And we believe that's already happening. And there's about $1 trillion of auto paper. Now, this won't be a systemic risk, but because auto paper was the best performing paper during 08-09, this is going to be quite a surprise to a number of investors. What's another weak link in the United States? Well, corporations have a lot of debt. Why do they have a lot of debt? Well, they've been catering to short-term shareholders who want them to buy back shares and don't mind that they're leveraging up to do so. Or they want them to pay dividends and don't mind that they're leveraging up, becoming more indebted. Well, this is becoming a big problem for certain sectors of the economy that are in the throes of disruption, both cyclical and secular. And I think the retail sector is one of those. We remain astonished at the inventory buildup taking place out there. And the way we're looking at this now from a deflationary point of view, and we think that's the bigger risk now out there, is the pipeline is full of deflationary indicators, starting from commodities, and we'll get into that in a moment. But at the end of the pipeline, downstream at the consumer level, retailers are awash in inventories. And the latest one, pretty provocative, is Nike. And Nike is both a retailer, but it mostly sells to retail. Nike's inventories increased 44%. There were already telltale signs that the consumer was weakening. Its North American inventories were up 68%. And the inventories in transit, mostly from Asia, so they're on ships, were up 85%. You know what's going to happen. In order to clear the shelves, Nike is going to have to cut prices, and retailers will as well. And we believe this is just a microcosm of a much broader problem out there. And we think we'll see it in full force